What if I told you that trading isn't as complicated as most people make it seem? Would you believe me? I can prove it to you. I have placed thousands of trades, made all the mistakes, and in this beginner series, I'll break down the basics, common mistakes, and strategies to help you trade with confidence. I have summarized all the lessons that I learned along the way, and I will share with you everything that you need to know to start your trading journey and turn into an income-generating machine. All without needing any money. This is the series I wish I had when I started trading, so if you are ready to fast-track your trading journey with 5 years worth of insights, condensed into short, actionable videos, stick around, take notes, and let's get started. Now, the first part of this beginner series will be an introduction to trading. And it doesn't matter how much experience you have or may not have in the markets, I think that this lesson can help you, as sometimes it's also about the golden nuggets that are shared in between the lines. So trading involves buying and selling financial instruments such as bonds, commodities, currencies, or cryptocurrencies to make a profit. So if we have a look at this, if a trader expects a price to rise, he can buy an asset and profit from a market that is moving to higher prices. But at the same time, and this is a very common misconception, we as traders can also profit from markets that move to the downside. This is called short trading and something I will cover on further videos. Okay, so we can profit if a market goes up, but we can also profit if a market goes down. And now let's have a look at typical types of trading. We have different assets that we can trade. We can trade stocks. Stocks refer to shares of a company with which we can buy or sell to make a profit. Besides that, we can also trade Forex. So Forex could be a pair. This is a currency pair like euro against the US dollar. At the same time, we can trade commodities such as gold, oil, or silver. So here we can see the gold futures. And besides that, we can also trade cryptocurrency. A very famous example for this is obviously Bitcoin. Our primary goal as traders is to make a profit by capitalizing on market movements. Our secondary goal would be capital preservation. This could be protecting the trading capital from significant losses, but also risk management. This refers to balancing potential profits with potential risk, which in trading we call risk to reward. And for that, we have an inbuilt risk to reward tool in TradingView that we will also cover along the lines that is automatically calculating our risk to reward. So if we look at a trading setup like this on Bitcoin, it's going to show us a risk to reward ratio of 7.86. This means this trade aims to make 7.86 times the amount of risk that we are taking in this particular trade. Now you can see when I adjust this risk management tool, you can see that this is obviously going to change. How can we as traders achieve these goals? And our primary tool is the technical analysis, but also fundamental analysis to make informed decisions. Now, if we go back to TradingView real quick, I want to share with you just one simple tool of technical analysis that made it possible to predict a rise in the gold market of over 6%. Here I was simply looking at a previous supply zone. Now don't worry, this is something I will cover along the way, but this is a very simple yet extremely effective technical tool that allows us as traders to capitalize on a nice price increase like we've seen here. That was all made possible by being able to use and identify these technical analysis tools to identify good places to buy an asset. Now, the next thing we have to do is look at strategies. So we have to develop, but also follow our trading strategies. So the next thing we have to look at is the difference between trading and investing. So one of the main differences is the time horizon. So as traders, we are mostly focused on short term. This can be minutes, hours, or days. Our objective as traders is to make quick profits from short-term market movements, which we can predict or try to predict by using technical analysis. The activity level of a trader is high frequency buying and selling. This means that within a short period of time, a trader can take multiple trades, while an investor is more often than not positioned and is going to hold on to that position for a very long time. Risk. As traders, we generally have a higher risk due to market volatility. We as traders are exposed to the low time frame market volatility, while an investor can just stay in an investment and don't really care about the low time frame price volatility. So now let's have a look at the characteristics of investing. The time horizon is long term. It can be years or even decades. The objective as an investor is gradual wealth accumulation through long-term growth. The activity level is low frequency buying and holding. So let's have a quick look at TradingView for this. If we look at a very high time frame chart, an investor might buy an asset down here in the year of 2015 and hold on to that exact same investment all the way up to here till 2024. A trader, on the other hand, would take multiple trades. He can take a long trade, aiming for higher prices to come down here. Then he can take a short trade, go into a new long trade, then take another short trade, take another long trade, and take another short trade up here. So while an investor is just holding on to one single investment, a trader tries to capitalize on different and multiple market movements. The risk is generally lower due to the focus on the long-term trend. An investor can sit out low time frame volatility and hold on to a long-term investment. Trading is a dynamic and active approach to making profits in financial markets. It is offering many opportunities, and that's what we like about trading. The goal of trading is to profit from short-term market movements while managing risk. As traders, we can even refer to ourselves as risk managers. I'm going to go through that throughout the beginner series, but risk management is the most important thing in trading to ensure that we can have a long sustaining career in trading. So, trading and investing differ primarily in time horizon, activity level, and risk. So the next steps for us will be to understanding market analysis and developing a trading strategy. So see you in the next videos, and I hope you enjoyed and could take something away from this series.